So I think what I'll do is put on maybe 3 live trades today just to go through the whole process, what I'm looking at, so we can talk a little bit on live trades. I'll do an earnings trade. Look at Apple. That's kind of a busy one. And that would be in this, and then I'll do maybe a trade in SPX or RUT, and then I'll do a trade in the stock. And I'll kind of talk as I'm going through those, how they might fit in my a portfolio of option trades that you're doing on a monthly basis, so it just doesn't seem random. So let's start with, let's look at Apple. And again, the idea is to encourage you to go out there and practice, put some trades on, get used to it. But I think, again, even if you're learning the options business, do I think you should just put randomly trades on? No, I mean, I do think you should put repetitive trades on if you're doing whatever the strategy is, calendar, butterfly, credit spread, iron condor, put it on a regular basis in the same vehicle. But I think you need to put, whether you're trading $500 or $50,000, I've got a plan. I'm trying to make 5% a month, 7% a month, whatever. Not that you're going to get it all the time, but you need to have some kind of target. It can't just be some random, because if it's so random, if your trading is random and you don't have a plan and you're putting these on, when you think the market's going down, you're going to see a lot of erratic returns too. You're going to trade sometimes, you're not going to trade other times, so it's hard if you're trying to make a consistent monthly income. It's shocking, but you have to trade, don't you? Yeah. All right, so let's start with, let's take a look at Apple. And you can see Apple here is trading right now as we speak, around 105 bucks, 105.19, but let's call it 105 for posterity's sake. And if you look, so we're about 105 bucks, and you look at the April expiration that expires this week, and you look at the at-the-money April 105 calls that are trading about, bid is $2.54, ask is $2.55, very tight market because you're in Apple. It's the most liquid stock in the history of the universe. The next thing is you see the option volatility of the at-the-money call is 50. In the expiration, this week's expiration, it expires April 29th, right? April 29th is Friday, so that's this week. So the question is, why is this week's at-the-money call 50 volatility, and why is next week, a week from Friday, why is that expiration, if we look at the at-the-money call, right, it's just priced a little bit higher than this week's expiration. Why is it only a 35 volatility? Anybody know? Why is, is John and Scott said the earnings are tomorrow night after the close. They were supposed to be tonight after the close, but I guess there was a death, one of the board of directors, so earnings will be tomorrow night after the close of trading. So you have earnings, the implied volatility are going to be higher in the expiration. That's going to be directly affected by the tornado called earnings. So we start with this. We know earnings will be Tuesday night after the close. And right now, stock's around 105 bucks. And so everybody with me so far? Yes, right? And if you look at a price chart of Apple right now, was I looking at Apple? Yeah. If you look at Apple, let's see. Apple was kind of on a steady rise, like a lot of stocks. With the correction in the market, Apple went down, and then like many other stocks, we've had a bit of a rally, right? Since the bottom of the correction in early January, many stocks have risen with the S&Ps and the Russell. And so McDonald's has come from the 95 level, which was in early January or middle of January after the correction, kind of rose up to this, whatever this is, like maybe 112 area, Apple. I keep saying McDonald's, Apple. And then we've kind of given up a little bit, and we're at 105. So if you look at the range since the correction, and basically a rally from 95 to 112, we've backed off to 105. So not that far from the middle of the range, right? Maybe just a little bit up. So we're at 105. Now, what is the projected move? You look at the projected move. Well, if you look at the last, I don't know, 10 earnings, probably the average move is around 4 to 5%. Now, when I look at the move, I just want to be clear. Earnings are coming out Tuesday after the close. I look at where they are Tuesday at the close of trading and then where they open Wednesday morning. Some people might look at, you know, earnings where they are Tuesday at the close of trading and then where they are at the end of the day Wednesday. Why don't I do that? I look at it because Tuesday morning or Wednesday morning, after earnings come out Tuesday night, will be reflected in the price. The gap will come Wednesday morning. So I can trade, right? Wednesday morning. All right, so the straddle, if you look at the calls are around, I'm just rounding this 250. The puts are 235. I'm going to round it up. At the money straddle, it's around $5, right? So with the stock at 105, what's that? About a 4.7, 4.8% move. Now, AJ says in January 16, last earnings, the move was 6.6%. Now, here's the question to ask there. Was the move 6.6%? In other words, when we say the move last earnings was 6.6%, are we saying the move, right, from the close of trading when earnings are announced to the opening is a 6.6% move? Or are we saying from the close of trading when earnings come out or released to the close of trading the next day? And I think what AJ is mentioning in January 16, last earnings move was 6.6%. I'm guessing that was at the end of the day, the next day after the next day, that was not the opening. I would bet my one pair of dirty socks that we did not open 6.6% up or down. I'd be willing to bet some Portillo's hot dogs on that. So my guess is we did not open 6.6% down in January when earnings came out or up, that it was, my guess is the opening was less than that move. If somebody wants to check that out and let me know, you could just look at a price chart and look for opening, right? Look at the opening. I could do that, but if someone wants to do that and see from the previous night close to the opening, what was the move? And I'm guessing it was different than 6.6%. Anyways, so what am I thinking here? Apple over the last 2-3 years, has Apple gapped up or down? So the expected move, now why do you say, Dan, it's the expected move? Well, it's really because if somebody bought the straddle today, they would, for $5, they would need it to move $5 just to break even, right? These options, if you bought the at the money 105 straddle today, it expires Friday. If you bought it for $5, you needed to move $5 up to 110 or down to 100 to break even. So why would you do that? Why would you pay $5? Well, I'd only buy the straddle today or tomorrow if I thought the move, the expected move, was going to be more than the expectation. Maybe 8% move, maybe an $8 move or a $9 move. But if I don't think it's going to move as much as the expectations of $5, then I might do some type of strategy that makes money if we're within a range, right? Yeah, so as Bosa just put there, the opening price of Apple last earnings was 96. The closing price was 93.42. So it only opened opened down, what would that be, 3%? So if I had a trade on, could I have gotten out at the opening? Absolutely. So that's what I look at with earnings is I'm more interested in the move to the opening, not the close. Because it's basically saying, well, you have 6 hours during trading that you can't do anything. That's not true, right? You're allowed under the laws of the Geneva Convention to trade, right? And so to me, it's the opening print. And Apple, I don't know how many years you would need to go back when Apple moved at an opening gap for earnings 5 or 6%, more than 5 or 6%. In other words, I don't remember, right? The only time I remember, you ask me, when do I remember Apple moving 5% or more for that opening gap on earnings? Before we split, before the stock split, right? Once it split, it was a lot quieter. I'm not sure how many years ago it split, 3, 4. So anyways, with all that said, I would be taking the point of view that, hey, I don't think it's going to move gap more than 5 or 6 points. So I might do, in Apple, I might do some type of an iron condor type trade. It makes sense to me. But because anything can happen with earnings, would I do it 50 times? No, because it's going to gap, so I can't do anything until it opens. All right, so what might be something now? So I might try to get a little more room if the expected move is $5. And all that means is, really, you can say it's the market maker move, but where do they get? How are they pricing it? They're not geniuses. They're pricing it based on what has Apple done, right? What is the average move in Apple over the last 2-3 years? It's been about 4.7%, right? So if they're pricing the move at $5, are they geniuses? Should the market makers get Nobel laureate prizes because no. Market makers have the same ability that you do, right? They can look in the newspaper and see what did Apple do the last 3 years on earnings. Isn't that amazing? Does that make them real smart? No, right? John says, do you take into consideration what has happened to the other earnings moves last week, a big negative move from that? Yeah, I think that's important to look at, especially stocks that are in the same industry that kind of move like Apple. And there's been a lot of negative movement, right? So would that be part of my homework for making a decision? Absolutely. Looking at similar stocks, and we had negative earnings in most of these, and yeah, I would look at it. I definitely would look at it. And the other thing to think about is this. Say we have negative earnings, which way has the market gone in the last 3 months? Are most of the stocks probably in the upper end of the range anyways, right? In other words, what has the market basically done? The S&Ps are up, what, 15%? 14%? Right? In the last 3 months. So most stocks are going to be in the upper end of the range. Agree? I'm not saying that's the reason why maybe you have a lot more negative earnings, but most stocks have, wouldn't you agree that many stocks have run up in the last 2 to 3 months? If we've been kind of the bottom of the correction at the end of January, and you say that most stocks since the end of January, now we're almost at the end of April, 3 months, they've gone which way? Up, right? So just like where everybody's looking for maybe a little bit of a pullback in the market, it's not unusual, as Tom Jones would say, for some of these stocks to back off. But anyways, so yes, I would look at stocks in the same industry and stuff like that. So the bottom line is, do I think I'm okay till the opening from Tuesday night to Wednesday morning on maybe a 6 or 7 point move in Apple? Yeah, I think so. Again, this is a spec trade. and it's how much room you get, right? So I don't look at these earnings. A lot of people will look at, well, I would do, some people might say, well, I like to do, iron condors and Apple or Netflix or Google because the volatility is high around earnings and I do it, right? I don't do it for that reason. Right, so I'm not doing it. In other words, most of you may, if I asked you, why do you do a Google iron condor? Why do you do a Apple iron condor or a Netflix or Starbucks iron condor or short strangle for earnings? And what might you tell me? Most of you might tell me, Dan, I'm doing it because the volatility is high, right? I look at things a little differently. I don't do it because the option volatility is necessarily high. Because I look at, there's a specific event. I do an iron condor and Apple because I think the projected move will be less. I think the actual move will be less than the expected move. I do an iron condor and Google because I think the actual move will be less than the expected move, right? That's why I do an iron condor on those. Why would I do, if it wasn't earnings, so that's how I treat, not looking at the implied volatilities and making my, they should be, I'm not getting caught up in the high volatility or earnings stuff because it's for a reason. Now, when we've had the correction in early January, if Apple's volatility goes up because on the market event or SPX option volatilities go up, that's more real to me, right? It's going up. There's not, it's an event. We're correcting, the market's going down, but that to me is more legitimate volatility, when I look more for opportunities a little differently than I would with earnings. Earnings is an event, and the difference is with earnings, I can't adjust Apple when earnings come out until the stock opens. So, I look at these as much riskier ventures than I do going to SPX or Russell when the implied volatility gets high because the market goes down. Those are much better opportunities. Steve says, so the bottom line is you need to have a bias on price movement direction. If I'm doing an iron condor, the bottom line is this. If I'm doing an iron condor in a stock during earnings, it's because I think the expected move, I think the actual move that's going to happen is going to be less than the expected move. And that's why I would do an iron condor, right? I'm not doing it just because the implied volatility is high. The implied volatility is high for a stinking reason, right? Because the stock moves 5% of the earnings, right? Anyways, so with all that being said, all that nonsense being said, let's see what we'll do here. So let me close a couple of these things. So if Apple's at 105, I think what I might do is, let's see how far out of the money I can go. So if I did an earnings, let's see, iron condor, Apple, and let's see, so stock's at 105. Let's say if I go 6 points out of the money. So if I sell, if we're at 105, I'm going to sell the 111 calls in the expiration that expires this Friday. I want to go 6 points out of the money on the upside. So I'll sell the 111s, and this Apple, maybe I'll do my wings 5 points away. So I'll buy the 116s. I'll repeat this again. And then on the downside, 6 points away, maybe around 99. So I'll sell the 99 puts and buy my long puts 5 points away, 94. And I'll tell you my thoughts. All right, so here's the trade. Apple's at 105. I'm going to get 6 points protection either way. So I'm going to sell the 111 calls. Again, which expiration are you doing? The expiration that expires this Friday, the weeklies of this week. Sell the 111 calls, buy the 116 calls. On the put side, I'm selling the 99 puts, buying the 94 puts. The total credit right now is going for 75 credit. I wouldn't go lower than that. Normally when I'm doing iron condors where the width of the credit spreads are 5 wide, I usually want minimum, I don't want to go lower than 80 cents. So I don't want to go under 75 here because I'm moving away from kind of my ideal target. So it's trading at 76 cents right now. And I'll just play around with what price I want to do it. I think I'll go in with one contract or two and just kind of see where the market makers are willing to do business. So 75 cent credit is, well, the mid is 76. So I'm going to go at 76. Let me see if I get filled at 76 cents. And so I'm not getting filled at 76. And the mids are pretty tight in there. So I might go down to 75 cents. And I'm just going to wait a little bit for that. Again, I don't like to say, Dan, why don't you like to go too much under 75? Again, I want to get at least 40 cents aside when I'm doing 5-point credit spreads. And so I don't, you know, I don't want to like do it and get, you know, because if you look at my risk, I'm doing 5 wide credit spreads. My risk per unit is $500. Let's say I bring in $75 credit. What's my risk? 4 1/4 for every 1 iron condor I do. So with this being my risk and this being my reward, you know, I don't want to do it and get like, you know, get $30 credit for risk 470. I can get a good risk reward. I mean, I could get a good probability to go way, way out of the money, but, you know, one really bad earnings, I can give away, you know, lots of months of good trading. So I want something, and I kind of drew my line in the sand. I like to get, when I'm doing 5-point credit spreads, about 40 cents. Anyways, so that's where I am. It's close. I'm trying to get 75 cent credit. The mid is 74. I'm not going to cave in on that. And it's, you know, again, how do I determine my size? Do I do 1 contract? Do I do 10? Well, if my total risk on this is $425, well, how much am I willing to lose if something goofy happened? It hasn't happened in the last 3 years, but anything can happen with earnings. If something goofy happened, right, I'm only willing to risk 4 1/4, I would do it 1 time. If I was willing to risk 2 times 425, let's say 850, then I would do 2 contracts. If I was willing to risk $1,600 or 4 times this amount, then I would do 4 contracts. So and that's how I look at earnings. Earnings are a very speculative period. You get gaps. And so anyways, that's where I'm at. If I get executed during this class, I'll let you know. But that's where we're at, about 75 cent credit. Any questions on that? Now, I'm just putting this on live now because we're meeting today and we're not meeting tomorrow. But ideally, when would I want to put this on? Earnings are coming out Tuesday after the close. I'd put somewhere on the last 30 to 40 minutes of the trading day tomorrow. So any questions or comments on this whole earnings thing before we move on to SPX and look at a trade? Would you make any adjustment to this trade? No, I'm not. This is not a normal iron condor. I put it on. I'm going to take it off Wednesday morning, period. No adjustments. Advantage of iron condor versus iron butterfly. Iron condor will give you less reward but more room. Butterfly will give you much more reward but not as much room. So Butterfly gives you less room than the Iron Condor but more profit. Iron Condor gives you more room, less profit. How long do you hold? Wednesday morning. Wednesday morning, I'm out. If we open down, I'll take off the bad side, let the call side expire worthless. If we open it up, I'll take off the puts. I'll take off the bad side, which would be the call side, leave the put side alone. Which of your courses are best suited for the smaller trader with a starting account between 5 to 10,000? Won't you even be selling premium with a smaller account? Yeah, we have classes, archived classes, how to manage a 10K portfolio, or we have those classes. And you had a question about which class you should take. You can just send me an email at Dan@Sheridan. Just put it in there, Dan@SheridanMentoring.com. Based on your experience, be happy to kind of steer you in the right direction. All right. So any other questions on this before we go to SPX? But can you sell premium? Can you do this type of trading on a smaller account? As Sylvester Stallone would say, and I think he still does say, absolutely. I have new students do this on $3,000, $2,000, $3,000, $4,000. Yeah, but the important point is that you're doing live trades and building a foundation. Once you build a foundation of 30, 40 trades, then you're better prepared to move on. But you have to get a lot of trades under your belt and do them the right way. Is my target profit the entire 75? Oh, I love it, yeah. But realistically, am I going to be able to make the entire 75? No. So what I'll do is, again, if Apple opens down, right, tomorrow or Wednesday morning, I would close the put side either for a profit, a small loss, or a bigger loss. I'm done with it, and leave the call side expire worthless. If Apple opens up, I leave the put side alone at the Iron Condor and take off the call side for a profit, small loss, or a bigger loss. And that's it. Would you say if we are more bearish on Apple to do shorter spread on the, if you're more bearish, then you would just probably do the call credit spread if you are more bearish and not the put credit spread of the Iron Condor. All right, so if I look at SPX, SPX is at 2083. SPX is at 2083. If we move over to SPX, this is a trade that I would be considering right now. Okay, a little early expiration, not too bad. I'd still go the May 20th expiration, 24 days out. So I'm looking at the May expiration about 24 days out. Right, the regular May expiration, 24 days out. Expires, so the expiration is May 20th, expires 24 days out. And I'm looking for, when we're in the upper end of the price level, SPX is 2083, even though it's down 8 today, how many points are we off the all-time high? SPX is at 2083. How many points are we off the all-time high? Right, where SPX is 2083. How many points are we off the all-time high? Anybody know? Approximately. How many points we're at 2080, about 50, which is nothing, right? So when the market's up at these levels, generally, I'm looking for more of a balanced butterfly, and I'll show you one. I'd rather do it on an up day. I wouldn't enter it probably today. I will today just to show you. I'd enter it very small today because I'd rather do it on an up day. But when we're in the upper end of the range, Ian, what do you mean we're in the upper end of the range? With SPX at 2083, again, VIX is very low. So I want to be careful with short Vega strategy. So I'm just going to do a call butterfly here. And I'll explain what I'm doing in a second here. And I'll do it here. Let's see, SPX is at 2083. So I want to place my short options at the money. I'll go 2085. Let me set it up, and then I'll try to do it, and then I'll show you. So if you look at this butterfly, I'll just do it 1 by 2 by 1 for illustrative purposes. So here's the butterfly. I'm looking all calls, May expiration about 24 days out. I'm looking the May 20 expiration about 24 days out. And I'm looking to buy 1, sell 2 by 1, buying the 2055 calls, sell the 2085s, and buy the 2115s. It's about 24 days till expiration. And as we've been watching this, the mid prices are around 570 to 580. This says 580 is the mid price. And so I'm selling the at the money. Right now, SPX is at 2083.81. So the closest at the money strike would be the 2085. And that's how I would structure it, about a 30 wide, a butterfly here. Now the mids, they were 570, now they're 550. Price about the same. So I'm going to go in there and I'll just see kind of what the price is to get this done. So I'm going first at 550. It says the mid is 560, but I'm going to go in at 550. And not executed yet, right? I'll get to questions in a second. Mid 555, I went at 550. Now I'll go to where the current mid is 555. And, you know, it just takes a little bit. I just want to be patient, trying to get a good price here. So we're around 555. Again, this is a 25-day trade. Is the theta that big on a 25-day trade that there's a panic to get it on in the next 10 minutes? No. If this were a weekly trade, like a 3 or 4 day trade, I'm much more aggressive trying to get it on because there's a lot of positive theta. But, you know, with a 25-day trade, I want to get a good price here, right? Number one, I don't think we're just going to sit here at 2085 where a butterfly is worth the most at the money. So I'm going to be patient here, right? I'll either get executed in a few minutes, or as it moves away from this 2084, 2085 area up a little bit or down a little bit today, I would get executed at this. So I'm going to be patient, much more patient on a 25 to 30 to 40 to 50-day duration trade than I am on a weekly. Why? Because with the weeklies, theta, it's just like oozing from all the nostrils, whereas it's a little bit different when I'm dealing with 30-day duration, I'm much more concerned with the price move and getting good execution. I'm not as concerned with the weekly because it's, the tremendous theta. So the mid is 555. On a 25, 30, 35-day trade in SPX or RUT right now, I don't want to go over mid much. Right now, it just went, the mid went to 545, but, again, we're watching this. SPX hasn't done anything, right? SPX is still about the same price. So you can see mid prices move all over, right? So even though this says at 2083.67, mid price is 545, with the same price over the last 3 minutes, the mid price is more. So here you see the mid price is 595. So that's why you have to watch it, right? Especially with 30, 35-day trades or 50-day trades, the mids can move, right? We've moved from 540. We've got a range in the mids of 540 to 6, right? And SPX price has done what? Hasn't done squat, right? Hasn't done anything, right? So you just kind of, you observe, right? You observe. So to me, 555, and I haven't got executed, I'm going to stay there, right? Right? They're not filling me at 545, right? They're not filling me at 555. Even though these mids are higher, 570, are they real? Do I think I could sell a butterfly at 5? No, they're not. They just popped up. SPX hasn't moved the last 8 minutes much, right? So, but you're seeing a range, all over the map. And how do you know it's real? Well, you kind of see, again, I'm trying to pay 555 and I'm not getting executed, right? So we'll see now, could I cave in? I normally would cave in, but on a short Vega trade, right, with the VIX at 14, I'm not willing to cave in a lot, right? Because I don't think we're just going to sit here SPX 2083. Again, this is a 25, 30-day trade. So I don't think we're going to sit here. But because it's not a weekly trade, theta, 1 day of theta is not a big deal here. So to me, price execution is much more important on a longer duration trade as a shorter duration trade. And so I'm trying to pay 555. So again, when would you get executed? As we move again over 2085, if we move today or tomorrow, or under 2085, 5, 6 points, I can get executed. Or I might get executed today. But again, there's a specific reason why I'm being patient. So it doesn't matter whether I do put butterfly, call butterfly, it's the same strikes, same thing. So again, I talked a little bit about why I'm not willing to, my maximum I'm willing to pay is about what I'm paying. And I gave some reasons why I'm not willing to pay more, and it has to do with the market environment, the duration of my trade, and that's what I'm looking at. Right now, the mid says 545, right? So you can see, even with SPX right around here at 2083, well, now it's a little lower. Now we're at 2082.53, but still, we're within 1-2 points, over the last 10 minutes as we've been looking at this, and we've got, 60, 70 cent range here. Now, even though it says 545 mid, well, I'm trying to pay 555, 10 cents over, right? But during this last 10 minutes, the price of SPX has only been in a 1 or 2 point range, which is nothing for a $2,000 vehicle. And so I'm comfortable with the 555. I'm not getting executed. Right now, we're at 2082. We've come off about a point and a half. If we go from 2082 down to 2080 or 2079, why do I think I'd be filled at this order? Can anybody tell me? Why do I think I'll get executed if SPX goes down 1 more or 2 more points? Why do you think I'll get executed? Let me give you an answer. Butterflies, if I'm buying a butterfly, a call or put butterfly, where is the butterfly worth the most? At the short strike. Where is the butterfly worth the most? The answer is at the short strike. So as we move away from the short strike, so if the short strike is 2085, remember the butterfly is, this is the May expiration, about 25 days away. If you're selling the 2085s, that's the short strike. As we go away either direction from here, the butterfly is going to be worth less, right? So if we go from 2083.67 down to 2082 to 2081 to 2080, that's moving away, right? So then I would get executed at my 555 debit, which now is mid. So right around here, we're 2082.73. If we go to 2082, we're real close, just a little bit more, a little patience, and I'll get executed. So right now, I'm 555 debit. The mid is 555, but the mid's been all over the place, and we've only been in a 2-point range here, right? So that's why you got to watch it a little bit and kind of see with these orders, but that's how I'm looking at the order. Anyway, I'm more patient on the longer the duration. I'm less patient the shorter the duration. We'll make a song out of that, and we'll have some guitar acoustics to it next time. All right, last trade. So I'm waiting on that, right? I like to set the butterflies up at the money, right? And balanced, because I'm going to be, if I open a balanced butterfly, right? Dan, what do you mean balanced? Balance means same distance between all of my parts, right? And if I do that, I'm going to start out a little bit short delta against my short vega, right? Which is what I want to do when SPX is in the upper end of the range here, right? 2083, we're not that far from the all-time highs, and the VIX is at a paltry 14, right? Steve says, I think toss tells you how much the stock has to move before you get filled. I've never seen that, and I don't know how they would know. I mean, you can have an idea. I could tell you right here, you know, I'm telling you, where I think if SPX trades 2081, I think I'll get filled on this. Why? Because a butterfly, you pay more as it moves away from the short strike. So as we go towards 2081, that's more away from the short strike. So anyways. All right, last trade. So we talked about a iron condor. Here's a butterfly. So Andy says, so you are putting on a balanced butterfly because you think the SPX is due for a pullback. Let me word it differently, because I'm not a directional guy, right? I can't base an income trading business, right, on where I think the market's going, right? You with me? If any of you said, Dan, you know, put it this way, I wouldn't bet on any income business over a long period of time where I'm betting on you putting on a strategy based on your opinion. I don't value opinions that way because I think it's very difficult to pick the market, where the market's going every couple weeks for the next 3 years. Good luck. So why am I putting on a balanced butterfly? Here's the reason, right? How many points has the SPX been up in the last couple months? Does anybody know? How many points has the SPX been up in the last couple months? is why I'm starting just a few short deltas on this trade against my short Vega. How many points has the SPX been up? It's been up huge, almost a couple hundred points, 15% in a couple of months. We're 40, 50 points off the all-time high since Julius Caesar came to Chicago to open up a hot plate. So it's over 200 points, right? We're at 2080. We came from the lower 1800s, right? Anyways, we've been up a lot. So all I'm saying is if I'm structuring a trade, a short Vega trade, with the SPX near all-time highs and the VIX at 14, here's my question. You ready? Would I rather have more room before I get in trouble to adjust? Would I rather have more room on the upside or the downside? After 270-point move, and with the VIX being 14, and I'm entering a short Vega trade, again, I have no idea where the market's going tomorrow, and neither do you. But would I rather structure my trade at the beginning that I have a little more room on the downside than the upside? That's all I'm doing here. It's basically neutral. It just gives me a little more tinge. If you do a balanced butterfly in the SPX or RUT, it's going to start me just a little bit short deltas, which gives me a little bit cushion against my short Vega. That's it. Right? So, again, at 555, now we're back up to 2084. So because we're back up to 2084, 66, we're getting near the short strike. The mids are going up. As we move away from the short strike, when we were just at 2082, what did you notice? The mids got smaller. Right? And if we go, so as we get to 2085, the short strike, the mids will go higher. But then if we kept going up to 2087, 2088, 2089, 2090, away from the short strike, these mids would get lower. Oh, so that's how it works. A butterfly gets hurt on the upside and the downside. A butterfly gets hurt on the upside and the downside. Right? If we had a big move. Let me show you a graph of this trade. Let me show you a graph of this trade so you can see that. If we look at May, so we'll look at this trade. This is the exact trade that we were going over with you. So we're looking at the calls. We're buying the 2085s. Right? Buying the 2085, or selling the 2085s, we have the money. Buying the 2055s. And then buying the 2115s. You can see it's 585 debit, a little higher mid prices right now because we're moving towards that short strike. And we'll see what does the graph look like. That I just hit here. So you can see there that this is the graph at expiration. This is the butterfly. This is the short strike of the butterfly at 585. Excuse me, at 2085. Where the butterfly, where the risk kind of evens out here, This would be on the upside. This would be your long. This would be your 2115 strike. And this would be your other long, 2055. You make your most money at the short strike of 2085. All right, I'll just cut it off. 2 trades today. That's enough. I'm just spend a little more time on execution. We've gone about an hour. I don't want to go too much longer than that. And we'll continue next time we do a Monday webinar. We'll continue this. And, if you have any other questions on this, you can email me, Dan, SheridanMentoring.com. I just want to give you guys as far as a couple things cooking. A very good, really good seminar, June 6th. Just want to let you know, June 6th, go to our website, June 16, 17 in Chicago. We have a 2-day seminar with one of the better live seminars you ever see with options. We'll have 13, 14 different speakers, all option practitioners that will share what they do on a regular basis to make some money. And you'll see them with some really good speakers. And I think it'll be a great opportunity for you to kind of mix with a lot of option traders. It'll be June 16, 17 in Chicago. We'll have Tom Sosnoff from Tasty Trade, Brian Overby, and Jim Bittman with the CBOE, Brian Overby with Trade King. They'll be how to run a credit spread business. Karen Bouton, who's a big trader, as an account hedge fund at Thinkorswim. They call it Karen the Super Trader, just a nice lady, but she'll be there sharing some of the things she does. We'll have some fit traders in there, Sheridan Mentoring students. I'll be speaking. It should be a great, great event, and you can get some information from the website. Have a great day, everybody. If you have any questions for me, Dan at SheridanMentoring.com, and we'll see you next time.